It's Brian Preston, the money guy.
All right. Syrup Celine has a question. They're saving up to buy a car 2 to 3 years from now. Where should I park the money?
All right, so if you're going to buy a car, I'm going to answer the question. I'm going to answer if you're going to buy a car in 2 to 3 years, the place that you should park the funds for that is in cash. Purely liquid, safe cash. That's the answer to the question. Brian, I want to talk a little about why is that the answer to the question? Why is that the advice that we give?
Well, I mean, you got to have liquidity. I mean, 2 to 3 years, I wouldn't feel comfortable putting that out there in an investment asset. Like you go do the S&P 500, it might turn out to be outstanding, where you're actually getting 10 to 15% more than you would with cash. But it also could cut the other way, where you could lose 20 to 25% of that purchasing power just because of the volatility of the marketplace. So investment assets don't really hold up. You need a cash equivalent. So we need to maximize that.
And imagine, like, how sick would you be if 2 years ago you thought, hey, I'm going to buy a car in 2 years, and you invest, and then 2022 happens. And right about the time that morning you go out and your car doesn't start, and you look at your account like, holy cow, I don't have the money that I thought was going to be there. So if it's finite, cash is your friend. Now, I do give one little pivot, change here. If it's not finite, if you're thinking, hey, I might need to replace a car at some point in the future, but it might be 5 years or it might be 7 years, I think you can be a little more aggressive in how much you save in cash versus how much you save into a different bucket. But I think you agree with this, Brian. Anytime we have a finite goal inside of 5 years, it should be all cash to fund that specific finite goal.
But there is a better way to do cash, though. I think that's the part that you need to focus on. Is that, can you make sure your cash is at least being maximized? Because there is a broad difference from the way financial institutions are paying their customers for cash. Like if you go to your typical brick and mortar bank right now, their savings account might be at 20 to 30 basis points or 0.2 to 0.3%. Meanwhile, if you go look at the online banks, I mean, I don't get any affiliate fees for the sharing this. I just personally use like Ally.com, which is the old GMAC financing wing. They're paying close to 2.5% now.
Great.
I mean, and they do a pretty good job of keeping up with where interest rates are. And then, by the way, you're talking about a car, so I don't think you're talking about a 6-figure purchase. But it is important for those of you who run really fat cash reserves, because maybe you're in a really high income situation where your emergency reserves might be over $100,000. Do recognize that there are accounts that pay more for $100,000 minimums. Yep. Like we see this Fidelity Investments right now, just their cash reserves is like 2.5%. But if you have $100,000, they have another money market that will be like close to 3%.
It's 3.08% as of right now.
So that's pretty incredible. Now look, this might be dated a year from now. It might be higher, might be lower. But at the moment we're recording this, know that. So I would encourage you. No, you have a 2-year goal. So now how do we maximize this cash? Look at your current institutions. If they are underappreciating your relationship and not giving you a good yield on your cash, then go figure out if there's an online or investment option that still keeps it as cash, but also pays you more where the market is right now in this higher interest rate environment.